I think we're going to have a 2 to 3 year run with gold up to $5,000 and silver to 100. And if you do the math on the silver miners, there's not that many. There's 15 silver miners with a market cap over $100 million. There's not that many, 15. Of those 15, if you price them out at $100 silver, it's pretty wonky, the upside potential of those. And Wall Street's completely ignoring this story.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for May 12th through May 19th, 2025, while supplies last. First this week, we feature backdated 1-ounce gold American Eagles at just $89.99 over spot per ounce. 1-ounce 2025 silver American Eagles are just $4.99 over spot. Next, we have 10-ounce silver Royal Mint coins at just $2.99 over spot per ounce. The 10-ounce Britannia, 10-ounce Royal Arms, 10-ounce Little John, and 10-ounce Merlin are all 4.9s fine. And we have a very limited quantity. Again, they're just $2.99 over spot per ounce while supplies last. Next, backdated 1-ounce gold Canadian maples are only $69.99 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Don Durrett from goldstockdata.com. Don, thank you so much for joining us today.
Hey Elijah, thanks for having me on. You know, with your first name being Elijah, that's got to be difficult, because it has such a, religious connotation, right? It's like everybody must think you're like a saint. It's like your name's Elijah, so that you got to be a saint, right? That's got to be that's a tough first name.
Oh, it's tough to live up to, right? So, definitely. Well, fantastic. Well, yeah, we really appreciate your time today, Don. I did want to discuss what is happening in the markets today, or not today, but this week. We're recording this on Saturday. And also the historic debt downgrade. Now, pretty much, there's no rating agency, a major rating agency right now that has U.S. debt at AAA. They've all been downgraded now as of this week. So your perspective first on that and how it impacted the markets.
I don't know if it impacted the markets. I don't know. Did they announce that during trading or was it after? I wasn't sure. It might have been during, but it didn't affect the markets at all. Some people were saying that maybe it'll affect them on Monday. The other two rating agencies already had them, down one notch. So this was the third one. So now they're all down a notch. So I don't think the markets care. It's like, so what, you join the crowd kind of thing. But I think this is strike one. So strike one, we can kind of ignore. Strike two is when all three of them go down another notch. So we'll wait for strike two. And I think that one will be impactful. So as far as the rating agency, I think it is kind of an omen here that it happened, because those other ones happened a long time ago. One of them happened, I forget, years ago. It's kind of an omen that the third one happened here, because this is a really crazy market since Trump came into office and put these tariffs in place. And I don't see how the tariffs help, especially in the near term. So we had an economy that hasn't had a recession since 2009, that's been manipulated since 2009 with low rates and injection of liquidity to prevent a recession. So it's like the market has been held up, if you will, manipulated, and it still is. And Wall Street, it just has this optimism that the Fed and the U.S. Treasury can handle any glitches or any downturns. So everything's been these V-shaped recoveries, because everybody's like, we don't have to worry about a recession. Everything's fine. We have the masters of the universe controlling this economy. We have this U.S. exceptionalism. The U.S. is 25% of global GDP. The U.S. consumer, I just heard this week, kind of blew my mind. The U.S. consumer is 18% of global GDP. and the U.S. consumer is broke. What can break here? And then Trump's raising tariffs. So tariffs before Trump came into office, the average tariff coming into the U.S. was 2.5%. So basically, we had an open market for everybody. And Trump is going to raise that somewhere between 10 and 15% is my guess. Because I think he's going to have I think a 10% minimum on just about every country. And then China is not going to get Bissett said that his minimum is 30 for China. And China, we import about 20% of our goods. So 30% is there. So I think it's going to be around 12% is my guess. So we're going to go from 2.5, let's say 12 as a best case, right? Into a slowing economy, into a deficit, a budget deficit of $2 trillion. And it looks like that Trump is going to continue with the Biden's fiscal dominance strategy. He's not talking about cutting the deficit at all. And the Republicans in his budget bill are a little upset with him because he's not trying to raise taxes or cut spending. So that means that the budget is going to remain elevated, severely elevated. We're talking about 1.8 trillion plus. And that's not going to go down anytime soon, especially not this year, according to this tax bill. And the budget, I don't think, is going to be, any better. And so he's going to try to use this fiscal dominance to kind of keep the liquidity going in the economy, to keep everything going. And then people are anticipating that the Fed's going to lower rates at some point. Now it looks like they're probably not going to lower them in June. So we have July, August, September, somewhere in there, he's going to lower them. And, if the economy's straight, I always said that Powell, as long as the stock market is strong, he's not really going to cut rates quickly. He's going to use that economic strength as a reason to wait as long as he possibly can to cut rates. But he did cut them right before the election in September, which is really interesting. So I just think one final thing, I'll let you ask the question, is I actually think that the stock market can't go much higher here. We have a 21 PE, we have a slowing economy, we have tariffs coming in. It's like, where's the strength? Which sectors are going to push this thing higher? And I just think it's going to roll over here. So once we get below 5,500, as long as we're above, I've said this, as long as the S&P is above 5,500, it's everybody's happy. I call that the happy zone. It's like everybody, because you have the wealth effect. But if you go below 5,500, that's the danger zone. Now, I think we're going to fall back into that danger zone in the next month. I do. I think that this rally here is going to run out of steam, and the Trump tariffs are going to come back into the focus because Trump's not cutting his, like I said, the best case is 10%, 30%. And so you get back into that danger zone, and I think that's when things can crack. And I'm expecting them to crack.
Now, many experts that I'm talking to are really seeing this rise in the stock market over the last month or so to be kind of a dead cat bounce. And it seems like you're thinking kind of a similar thing is, we're probably not going to make new highs from here, and we could see a lot more downside potential. If we do see the stock market begin to crack again, what do you anticipate? How do you anticipate gold and silver reacting? Because I know last time we did see quite a bit of a pullback in both.
Yeah, I've always said that I say you get an initial whoosh down. So the whoosh is going to affect everything, except for the dollar and possibly bonds. But now people are afraid of long-term bonds. So where do you hide? And so it's possible, since the bond market is under pressure, it's possible that gold could go up. The stock market goes down and gold could go up. I mean, that's a possibility here because gold, all the fundamentals for gold are extremely strong. I raised my target from $4,500 to $5,000 gold because of these strong fundamentals in gold. And where those strong fundamentals really come from is Triffin's dilemma, where the U.S. is basically trapped here, relying on debt. And it's getting to the point now where everything's starting to break apart, and it's becoming very obvious here. And so that creates unbelievable support for gold, because Triffin's dilemma is playing out. That implies that the U.S. dollar and the U.S. bond market are both going to come under severe pressure. And the U.S. treasuries are literally the foundation of the collateral system globally. So if those things start to break, you can imagine all the fallout. And so all that fallout creates this fundamental strength for gold. So I think $5,000 gold is where we're going. So I've always said, well, not always, but I mean this year, that I don't think gold can fall more than 10%. Now, it just did fall 9%, 3,500 to 3,170. 3,150 would have been 10%. So it didn't quite get to 10, down 10. I think it's going to go down below 3,150 on the whoosh. So I think we're going back to sub 5,000. It won't go all at once, but it'll go fairly quickly, I think. And then once we go below 5,000, I think 4,800 gets retested. You see, S&P 500 and gold are really closely related. So yeah, so gold goes below, I mean, if S&P goes below 5,000, I think we retest 4,800. And so that's going to put a lot of pressure on gold. So gold, I don't think 3,150 will hold. I'm hoping that 3,000 holds. I think 3,000 has a good chance to hold. And once gold finds that next cycle bottom, which I think is going to be somewhere between 3,000 and 3,150, once it finds that bottom, it will take off. It'll just up $200 in 2 weeks probably, because of these strong fundamentals. Now, worst case is 3,000 doesn't hold. I think that's kind of worst case. And then you're looking at either a 29 handle or a 28 handle. But I don't see a 27 handle the rest of this year. I'd be very surprised we get a 27 handle, just because I just think these fundamentals for gold are so good. And so I'm looking at, hoping 3,000 holds, maybe a 29 handle. But I think it doesn't really matter much, because it's going to be a very short-lived, I believe, correction for gold, and then it's going to go higher. And it's just, gold's going to be just, the go-to asset, because bonds are not such a safe place to hide anymore. And if you can't, I've always said that the reason why I got into gold is because the U.S. bond market failing. And the U.S. bond market fails, gold is going to be the beneficiary. Now, most people think the bond market will never fail. Well, we're at right now we're at $2 trillion budget deficit. We have to borrow $166 billion on average every single month. And foreign money is starting to dry up. China at one time was at 1.2 trillion. Now they're down to sub 800 billion and dropping. I figure where they at, 780, 760. But they're no longer a buyer. They're a net seller. They were a net seller in, I think it was January. So China's a net seller of our bonds, the second largest economy in the world. Japan, because they've had to support their currency, they're the largest holder now, over 1 trillion, and they could come under pressure where they have to sell. So who's going to buy the bonds? So people are starting to realize the bond market is not as strong. So my thesis is actually playing out. That the reason why you buy gold is because of weakness in the U.S. bond market.
Now, can you expand a bit more on what you see happening in the bond market? I think a lot of people are surprised, that we're seeing rates this high for this long. And I know, a lot of people have been accustomed to easy money and, zero interest rates, but that kind of environment probably isn't coming back anytime soon, if ever.
Right. And this is a combination of factors. And the combination for me is Triffin's dilemma is really a big reason here. And most people, it's one of those kind of this concepts, a connect the dots kind of concept. Most people say, well, Triffin's dilemma has been around since the 1960s, Don. It's never happened. Well, Triffin's dilemma is like when you have a slow cancer that just takes, long time to finally get you, if you will. It takes a really long, extended period of time before, basically the host takes over the body kind of thing. And so Triffin's dilemma has been a steady negative impact on the U.S. economy. So what Triffin's dilemma says is that since we are the global reserve currency, that gives us an upper hand on a competitive currency because we have an unusual demand that they don't have. So our currency is going to be stronger than yours. And since our currency is going to be stronger than yours, you're going to have an advantage over us on making stuff because your labor costs are going to be lower than ours. And eventually that's going to, and he said this in the 60s and it's all played out. And eventually what's going to happen is your standard of living is going to go down and your debt's going to go up. And eventually you're going to have a problem where you can no longer have the reserve currency. In other words, he said it's a self-fulfilling prophecy. It's kind of a negative feedback loop that if you try to be the reserve currency, it's just going to eventually bite you. And that's kind of where we're at today. And so, we have to give the rest of the world dollars, and when they have that demand for them, it creates this upward pressure on the dollar. And now we're seeing it. And it's like, that's why Trump wants to get a lower dollar. It's the only way that you can make stuff and, make a profit kind of thing. And it's really difficult when you have a really strong currency. How do you compete? And so Triffin's dilemma is weakening the U.S. economy. So the middle class and the lower class, we're seeing stress that families haven't had, since the 1970s because of inflation, where the average family doesn't have any savings. And every month they have to decide what they're going to spend their money on, their budget. In other words, their discretionary spending is limited and it's not going to improve anytime soon. So what we're seeing is we're seeing stress on the system. And so that our economy is 70% consumer spending. And so if that's where the stress is coming, then the foundation of the U.S. economy, or the foundation of bonds and the dollar is the U.S. economy. And if the U.S. economy is weakening, you're not going to hold dollars or bonds. The only reason you're going to hold them is because they're strong. And so, in other words, if you sell a product to the United States and you get dollars back, and then those dollars devalue, you're losing money. It's like what do you give me these dollars for? So what they're doing, the Chinese, is they're taking those dollars and then they're buying our assets. And Trump's trying to figure out a way so they can't buy our assets. Like we don't want these stinking dollars. Like I said, their treasury bills was at 1 trillion, now it's at 700+ billion. They've been taking that money and put it back into the U.S. stock market and buying our assets or buying farmland, taking our worthless dollars and reinvesting them, and it's giving them an advantage. But so while their cities, China has these unbelievable new cities that popped up over the last 10 years. It's kind of amazing. They've been investing where the U.S., our infrastructure, our airports, our transit systems, nothing, right? Roads are falling apart. The U.S. is falling apart, and China's like this new shining city on the hill kind of thing. So we're losing we're losing the battle. And that's impacting the bond market. Everybody can see this steady decline. If you look at, obviously, open up your eyes to see it. The middle class is slowly being drained. And if you're in college now and you graduate, you're so far behind the 8 ball. You probably have, now we charge people to go to college, and you get out of college, you have $80,000, $100,000, $120,000 in debt, so there's a debt payment, and then a house costs $350,000, and it's really expensive to have children today. It's like what happened to America? The American dream has kind of gotten rug pulled, and it's not improving, it's getting worse. And so this whole Triffin's dilemma it's playing out before our eyes. And then when you tie that in with the von Mises bubble, which is another one that everybody said is total BS, but it has, because von Mises bubble doesn't have, it's just like the Triffin's dilemma. They don't have dates on them. You don't know when when you hit the wall. So von Mises in the 50s, he wrote a paper and he said that if a government uses debt to stimulate the economy, that's a bubble that has to be paid back in either two ways. One, you grow the economy, or two, you pay the debt back. And it's really, but through the growth, you pay the debt back as well. And so if you don't grow and pay back the debt, then the only other option is the bubble pops, which is somehow you're going to have some type of a financial crisis. So von Mises basically said you're either going to have a financial crisis or you pay back the debt. That's kind of sums it up. And guess what? We never paid back the debt. And so von Mises said, look out, people, MMT. So the other thing about the von Mises bubble is he said there's no free lunch. A government just can't print money. You can't print prosperity. You can't print GDP. He tried to tell us this, and then the Japanese said, "Oh, we don't believe that von Mises BS. We're gonna print prosperity. We're gonna print this debt, and it's gonna create prosperity for us." Right? That's what the Japanese did in the 90s. And the U.S. said, "Well, they did it. We're gonna do it too." But it's like your parents always told you. It doesn't matter what Johnny did. It matters what you do. I don't care. It's not right just because Johnny did it, right? So the Japanese said, "Oh, we can have as much debt as we want." They invented MMT, and then we gave it the name. And so that's where we are today. That's the reason why the bond market, to answer your question, that's the reason why the bond market is becoming fragile. That's the reason why we're at, 10 years at 4.4, and everybody thought it was going to go down sub 4. And the bond market, the bond vigilantes are saying, well, sub 4 with tariffs, probably doesn't work for us. You have a combination of risk and the combination of possible inflation, and we're not going to give you 4% on the 10-year. And so Besant's like, I can't get the 10-year below 4%. What do I do? And so, it's going to be interesting. So the bond market is this is something that everybody, that kind of studies macro knows, is the bond market is much more important than the stock market. And even Trump, remember when the stock market was going down, everybody said, Trump, he can't do these tariffs, it's going to hurt the stock market, it's going to hurt the stock market. And Trump said over and over again, I don't care about the stock market. He says, we're going to help Main Street this time, meaning that mainstream doesn't own all the stock market. It's the 1% crowd that owns the stock market. And he basically implied, I don't care about stocks, but he cares about the bond market. In fact, the reason why he's using tariffs, and tariffs as a tax, is because he's got to make the bond market stable. Without the bond market, the U.S. is dust, because we literally depend on the bond market to pay our bills, if you will. $2 trillion deficit. We're literally living on debt, living on credit, the U.S. government is. The problem is that starting around 2007, 8, I think actually lower, starting around 2002, when we had that last recession after 9/11, we started expanding debt at a much faster rate than GDP. That is when the problems started in a big way. The U.S. economy actually peaked in 1999. I mean, if you go from 1945 to 1999, there's a definitive, in my opinion, there's a definitive line in the sand in 1999, 2000. When the dot-com bubble popped, that was kind of the peak of the U.S. Economic hegemony. We balanced the budget in 98, 99. We were in great shape. We had no inflation. We had debt under control. We were the masters of the universe, absolutely. And then the dot-com bubble popped, and from then till now, so for the last 25 years, the U.S. has been on this downward spiral. I call it basically a train wreck you can't prevent. It's just a matter of when the train gets to that corner. It's heading to the corner. It's just, and it can't go around that bend. It's just a matter of how far down the track it is before we hit that corner.
Now, I guess we're talking about, the bond market. And also, I mean, if we circle back to what the beginning of this interview, we're seeing this downgrade, and I guess this lack of trust in U.S. debt. If we look long term here, how do you see this impacting things? And also, when it comes to the precious metal markets, I know obviously it seems like gold is being seen as an alternative here. Your new forecast for gold seems, has increased based on all of this. So how do you see the U.S. debt market possibly impacting precious metals?
Global exceptionalism and U.S. hegemony, and the fact that the U.S. has the strongest economy and 25% of GDP has basically blinded people to kind of what's coming. It's for me, it's clear as day. I've actually been studying the future for 35 years. I actually knew this was coming. I because of all of my research, I study esoteric information, which the average person doesn't study. It's kind of odd. I mean, the sources that I have, nobody in finance has, if you will. The esoteric sources that I have access to is kind of mind-blowing because most people they stay away from that type of stuff. But what I found a lot of correlating data from diverse sources that all basically pointed to the end of the U.S. era. And it started for me in 1989, and I found a lot of information in the early 90s, from like 1990 to 95, a lot of correlating data that said that the U.S. era was ending. And I first found this source in 1989, and then I kept finding correlating data, kept correlating it and saying it over and over and over again. And so I'm like at least 90% certain, if you will, that the U.S. is pretty much, there's no way it can fix its economic problems here. There's only one path forward. I wrote a book, by the way, it's on Amazon, that talks about all my research. I put it all in one book called The Path Forward. That book will explain exactly what I think is going to come here in the next 5-10 years. And so gold is basically, and gold and silver are like, they're the winner here. I also think Bitcoin is going to do extremely well, but they're the winner here because U.S. economy, like I said, is heading for a train wreck. And once it falls off the tracks, if you will, it's like a Humpty Dumpty scenario. Humpty Dumpty right now is on the wall, just barely hanging on, and it's going to fall off and crack and smash into 1,000 pieces, and there's be no way to put it back together again. So the next 3 years, this is this bull market in the miners that's coming. We haven't had it since the last one was 2002 to 2011, which is 9 years long. This one's going to be about 9 years long as well. I believe it started in 2019 for gold. I think December 2019 is kind of when it started for gold. I think it's going to go to 28, another 9 year cycle. So we're just really starting, but it's just starting now. And so gold and silver and the miners are really going to be the big beneficiaries here once the U.S. economy goes into recession. Now, I don't think that once this recession begins, that the Fed can save us. The Fed, the Treasury, and Trump can save us. In other words, I don't think this is going to be a normal business cycle. And I think people are starting to feel it. I've known this for years and years and years, and now more and more people are starting to feel it, that we're screwed here. We let the debt get too big, and now there's no easy answers. And so, people are talking more today about a reset. Well, a reset that's kind of an end game type of scenario. And you're seeing more and more people talk about reset because the bond market is no longer tenable. I saw a quote from Dalio today, and I was like, did he really say that? I didn't check to see it. I mean, he said something to that effect, that things are going to get pretty wonky really quick here, people. Because if this stuff spins out of control, it's like kind of a Katie bar the door scenario. And so, I mean, I talked about it. I'm kind of 90% certain. I'm very confident that this is how it's going to play out. That we are going into a recession, and when we do go into recession, there's not going to be any easy answers here for the business cycle. For example, if you look at 2020, how much money they spent to to avoid that recession. To avoid a recession in 2020, they spent a lot of money. I don't know how many trillions of dollars it was, but it was more than 5 trillion. It was a lot of money. Some people said they printed like 40% of the entire money supply in like a year. But this time they can't do that. So this time when we go into recession, the Fed, their hands are going to be tied to a certain extent. They won't be able to cut rates rapidly, because if you cut rates rapidly, you're going to create inflation. And if you print money rapidly, you're going to create inflation. And if you create inflation above 5%, you literally are destroying the currency. So their hands are going to be tied here. What in the world do we do? And so I think what they're going to do is they're not going to print all that money, and they're not going to cut rates. They're basically going to try to prevent a depression, if you will. And I think they'll be successful at it. I think we're going to have a stagflationary recession, but I think they're going to lose control around 27. My guess is 27 is when you're going to get this reset. In other words, they're going to, in 25 and 26, they're going to kind of try to keep it going, if you will. But once we get to 27, I think that's when the wheels kind of come off the train, and they have to do a reset at that point. But the bad news is that the reset is not going to be good. It's not going to work. It's not going to be good medicine. It's actually, I hate to say this, but because I love America, I love the Constitution. We had this, I call it, the American experiment. We're the only country that created the Bill of Rights, where the people's rights came first, not the government's rights. We came first. You cannot take away our sovereign rights. We're the only country that has that, which was a beautiful thing. But we've reached a point now where there's not enough people that kind of believe in the Constitution. So the Constitution is kind of on fire right now, and it was kind of getting burned up. And so now, what's next? And I believe you kind of need to get on board of the fact that we have to create something new. We have to pivot into something new. We can't look back. We have to look forward. So you can look back, and we look back in the Constitution and say, we're going to hold on to that, and we're going to make that work. But that's not going to be the path forward. We're going to have to reinvent ourselves. And so this is this is the shift point right here. 2016 is when Trump got elected. That's when it kind of began. And then we had COVID in 2020. I thought this 4-year cycle, I thought that 24 was going to be another big economic move, but it wasn't. It's like the can got kicked down the road. So now it looks like 25 is going to be the year when the economic changes come. But I think that everything that I've said here, I think resonates with a lot of people, that things have gotten to the point now where there's kind of no way out of this, and we have to reinvent ourselves. And how are we going to do that? And the way we're going to do that is we're going to look forward. And I'm very optimistic about that. I don't think it's going to be violent at all. I really don't. Because I think what's going to happen is people are going to group together in regions. And so they're not going to fight each other, they're going to group together. So you'll go where your people are at. That's the way I see it. And there's going to be people that basically show the way forward, if you will. So I'm optimistic in that regard. But the miners, I think that all we're going to have here is, a 10 to 20% correction in the miners. I don't think we're going to do worse than 20%, especially in equality names. And that 10 to 20% is going to be short-lived. And then I think we're going to have a 2 to 3 year run with gold up to $5,000 and silver to 100. And if you do the math on the silver miners, there's not that many. There's 15 silver miners with a market cap over $100 million. There's not that many. 15. Of those 15, if you price them out at $100 silver, it's pretty wonky, the upside potential of those. And Wall Street is completely ignoring this story. Wall Street is, they don't want anything to do with, these silver miners at all. I mean, look at Heckler & Koch right now, how cheap they are. Nobody wants to touch them. And so that will all change once the fear trade comes in, and these miners are going to do things that are kind of, very wonky kind of thing. We're going to see stocks go up 50% in a single week. That's my expectation. And it's like, so we'll see stocks, going up, 20% a week after week after week. That type of outcome. We're very close to the finish line here.
$100 silver, I think, is looking more and more reasonable by the day. Especially when we have a gold, almost touching 3,500 here a couple weeks ago. I did want to ask you about the gold silver ratio. If we see $5,000 gold, $100 silver, that's 50 to 1. That's half of what it is right now. So silver is likely to outperform, but maybe I did want to push back a little bit, because you have some people talking about how, the central banks are buying gold, not silver, and that we might be kind of in a new era where this gold silver ratio kind of is here to stay, around 100 to 1 or even higher. Your perspective on that?
All you have to do is look what silver. So silver, the only time the GSR, the gold silver ratio, the only time it squeezes down is when silver is a proxy to gold. That means when it's a proxy to gold, that means silver is perceived as a monetary metal. Well, that only happens when you have a fear trade. So if you go back and you look at what silver did, it's only happened, we've only had two of them. So the 1970s, you had silver go all the way down. The GSR went all the way down to 17. 17. And then that was a serious fear trade in the 1980s, because you had inflation out of control and you had a recession. You had stagflation. So when we had stagflation, you had the GSR squeeze all the way to 17. Now, some people will say that 17 is misleading because you had the bunker hunt thing. But even if you take the bunker hunt out, I think you would easily got to 30 to 5. And then in 2011, the last time we had a fear trade from 2002 to 2011. And the reason why you had the fear trade is because you had 9/11 and 2002, and then you had the great financial crisis in 2007. So those two events, we created a fear trade there. That time, the GSR squeezed to 39. But if you remember, the final move from silver from 40 to 50 was very short-lived. And so I believe that if that would have lasted a year, 6 months, we would have got to 30. So I think a 30 GSR is totally legitimate if you get a fear trade. Now, I'm using 5,000 to $150 GSR, which I think is very conservative. I think it will go 40. So I think silver will exceed $100. I think it will get to 100 before we get to 5,000 is kind of my point. Now, about the people that think that the GSR is going to stay elevated, they talk about how, if we go into a recession, there's not going to be as much demand for silver. And that's true, but I don't think we're going to get a depression. I think we'll get a recession. If you get a recession, I think that silver is going to maintain. I think that electric cars are just going to continue to be needed, and I think solar and wind are going to continue to be needed. So I don't see silver demand just drying up. And so the silver demand is going to be there. And then investor demand I think is absolutely going to explode. There is not very many billionaires, if you will, that have any silver. And if they decide they want to have a few pallets of silver, I don't think there's a lot of inventory of 1,000-ounce bars. I'm expecting a shortage in silver very quickly. When silver gets to between $40 and $50 silver, I think that we're going to see a shortage in silver in 1,000-ounce bars. And the reason why is because people can kind of smell the blood in the water kind of thing. And people are going to realize that there's probably not that much silver out there. It's kind of like the Bitcoin, the rarity thing. I want to get my hands on some 1,000-ounce bars because there isn't that much. And all you need is a few billionaires and they can wipe out that inventory. and once they wipe it out, you have a shortage. Now the shortage won't last long because you have incoming silver. We mine 800 million ounces a month. So as soon as they're out, here comes the silver in. But my worry more than anything else is that when the shortage happens, the government is going to come to the rescue of these manufacturers. For instance, if Apple cannot find silver to make their iPhones, they're going to make a phone call. They're going to say, I need some help here. And so I believe that they're going to outlaw ETFs. I think that's the first thing they'll do. And so that'll dump about 1 billion ounces onto the market. But I only think that's going to be a short-lived solution, because once you have a shortage, then the billionaires, they're all going to notice it. And they're like, okay, how much money is that? So at $50, 1 billion ounces at $50, $50 billion. $50 billion isn't that much, really, and you think of the global marketplace. But plus, once you get a shortage, it will take about 6 months to resolve, even if they open up they dump the ETFs, all that inventory. And so I think it'll be a short-lived solution and silver prices go back. But I think that will happen. So you're going to have we don't know exactly how that'll play out, but I think it's going to be an initial downward surge of silver prices. Maybe they'll drop around $10, $15. So let's say we have this shortage and silver's like 65, 70, somewhere in there. We drop back down to 55, 50 because they dump $1 billion onto the market. But I think that's when the kind of the blood in the water starts and everybody wants silver, It's like, okay, we had a shortage once. What's going to create the shortage next time? How much silver is out there? It'll create more demand for silver, I think. And the one thing they can't do is they can't outlaw consumers, retail, from buying silver globally. Now, they could do it in a country, but that doesn't stop the world. The world can still buy silver. So all they have is this one little ace in the hole, which is 1 billion ounces in these ETFs. That's the only card they can play. But ultimately, I don't think that's going to stop silver from going to 100. I think we get to 100 all day. I don't think anybody should sell their silver miners at $50 silver. There's going to be a lot of people that take profits at $50 silver. And I think it's a big mistake, because I think that $60, $70 silver is easy. I'm okay if you wait till 60 to take it, but 50 is too early. I think 60, 65, 70 is kind of a better place to exit. The reason why I say that is because $50 silver is the all-time high, 49. That was in 2011. So if you change that for inflation, it's 68. Well, guess what gold is? Gold is at its all-time high adjusted for inflation. It's been way above it adjusted for inflation. I think 2,800 was the adjusted. So we're way past it, right? Silver is going to go to 68. I actually think 68 is a really good, initial place to take profit. I mean, if you want to sell half of your Pan American silver, I wouldn't sell half until 65. I just think 50 is too soon. But I'm going to take profits from 80 to 100. 80 to 100, especially in Mexico. I'll probably take some profits at 65. I'm overweight in Mexico because Mexico has a lot of silver miners. So 65, 75, 85, those I will be taking profits. And then once we get to $100 silver, I'll probably, who knows, might be completely out of my silver miners. I'll probably be leaving early because we might go 125, 150 on silver. But I think $100 silver and $55,000 gold are really legit targets. And people that are poo-pooing those targets are I think, missing this trade. And Wall Street's missing this trade. And everybody's going to be jumping on board at $37, $38 silver. Everybody's going to come running in. So the tell here for the gold, silver, miner bull market is silver. The reason why the HUI is still trapped in its channel, it's been in this channel since 2013. We're at the top of the channel today at 365. We've hit 365, like we hit it in 2020, we hit it again, we hit it like 3 times. But we're in this channel, and the reason why we're stuck in this channel is because of silver. because most gold miners, they also mine silver, and they're not making as much margin on silver. And so silver's the tell. And so once silver gets above 35, we're going to break out of that channel in a big way. We're going to be off to the races. So that's the big numbers. So the two big numbers, it's not gold. You can kind of ignore gold. You want to watch the $35 level for silver and the S&P. You want the S&P below 5,000. So I've been telling people on Twitter, if you want to buy, jump in like silver producers, you want to wait. You don't want to buy them today. The quality name. Now, if the stock is a 20 bagger, you can buy them anytime. But these quality producers, you don't want to get kind of rug pulled, because if you buy them today, it's probably going to go down 10 to 20%. So I've been saying wait until 4,800 S&P. But the corollary to that is the silver price. So if silver goes above 35 before the S&P goes to 4,800, then you buy. So you either buy at $35 silver or at 4,800, because once it gets above 35, it could rip to 45. You're going to be too late. It gets above 35, you got to. If you're waiting, you're on the sideline. Gets above 35, you got to get in. But my anticipation here is when we get to $4,500 S&P or 4,800, I think that silver is going to be down at 30.29, and you're going to be buying a big discount from here.
Well, Don, we always appreciate your analysis and really giving us a unique view of the markets here. If our viewers are interested in continuing to follow you, they can go to goldstockdata.com. We'll put a link in the description there. And I see the website is right behind you there on the screen. So we really appreciate your time. Any last thoughts before I let you go? And can you tell our viewers a little bit about your website there?
Yeah. So the website, it's not a stock picker website. A lot of people, they just want to buy what other people like. It's more of a data for people that already own gold and silver mining stocks, and they want to find more. And so I'm helping you. It's a tool to, I give you lots and lots of possibilities because I rate all these companies, but I want you to do your own due diligence. I want you to pick them because you need to understand them. So I've written a book that explains how to understand gold and silver mining stocks. So if you don't own any, read the book first, and then if it intrigues you, then you can then come to the website. So you can follow me both on Twitter and on Substack. Just search for Don Durrett, and you'll find me. Thanks for having me on, Elijah. It's a good talk.
Fantastic. Thank you so much, Don. You have a fantastic weekend here.
Thank you.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for May 12th through May 19th, 2025, while supplies last. First this week, we feature backdated 1-ounce gold American Eagles at just $89.99 over spot per ounce. 1-ounce 2025 silver American Eagles are just $4.99 over spot. Next, we have 10-ounce silver Royal Mint coins at just $2.99 over spot per ounce. The 10-ounce Britannia, 10-ounce Royal Arms, 10-ounce Little John, and 10-ounce Merlin are all 4.9s fine. And we have a very limited quantity. Again, they're just $2.99 over spot per ounce while supplies last. Next, backdated 1-ounce gold Canadian maples are only $69.99 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.